The current state of the markets. A look at the price tag. When you buy a stock, you are buying a piece of a business. And the most important question you can ask is, what is the price? You want to buy a wonderful company at a fair price, not a fair company at a wonderful price. Our job today is to look at the price tags on the world's biggest businesses, all bundled together in stock market indices. To do that, we will use a simple but powerful measuring tape. It's called the cyclically adjusted price-to-earnings ratio, or the CAPE ratio for short. Now, do not let the fancy name fool you. It is just common sense. A standard PE ratio is like judging a farmer by 1 year's harvest. It could be a bumper crop or a drought year. The CAPE ratio is smarter. It is like judging that farmer by his average harvest over an entire decade. It takes the price of the market and divides it by the average of 10 years of earnings, adjusted for inflation. This gives us a clear, long-term view of what we are actually paying for. To understand if today's price is high or low, we compare it to history using a percentile. If a market is in the 90th percentile, it has been cheaper than it is today. 90% of the time in its recorded history, it is historically expensive. If it is in the 20th percentile, it has been cheaper only 20% of the time. It is historically cheap. With that tool in hand, let's take a walk around the world and see what things cost. The global picture, the entire forest. Before we look at individual trees, let's look at the whole forest. The All-Country World Index now has a CAPE of 30.0, sitting at the 89.3rd percentile. In plain English, the world's stock market has been cheaper than it is right now, nearly 90% of the time since 1987. The world, in aggregate, is expensive. This does not mean it will fall tomorrow, but it does suggest the easy money from rising valuations has likely been made. Future returns will have to come the old-fashioned way, from the slow, steady grind of corporate profit growth. The American market, a premium price for excellence. Now, let's look at the headline act, the United States. The U.S. Large Cap Index has a CAPE ratio of 39.7. That places it in the 98.6 percentile. Let me be clear. Based on data going back to 1880, the U.S. market has been cheaper than it is today, over 98% of the time. It is in rarefied air. You are paying a premium price for a collection of magnificent businesses. The risk is that you are paying for decades of future growth today, leaving little room for error. The developed world ex-US, a tale of two tiers. When we leave the US, we find a more nuanced story. The developed world ex-US has a CAPE of 20.5, which is in the 54.1st percentile, almost perfectly middling by its own history. But this average hides stark contrasts. The expensive cohort, the Netherlands, at a CAPE of 28.1, is in the 87.2nd percentile. New Zealand, at 26.2, is in the 90th.9th percentile. Canada, at 26.6, is in the 77.6th percentile. These markets are pricey on their own terms. The relative bargains, the United Kingdom, the FTSE, has a CAPE of 16.5 in the 73rd.7th percentile. It is moderately expensive on its own, but compare it to the US. Its CAP is less than half. It is the difference between a premium brand product and a solid, dependable one that is on sale. The truly reasonable. Then we have markets like Denmark at 21.6, the 34th.9th percentile. Hong Kong at 14.9, the 30th.4th percentile. And Japan at 25.0, the 40th.5th percentile. These are far from expensive by their own historical standards. Japan, a remarkable turnaround. Japan's story is a lesson in patience. After decades in the deep freeze, its market has warmed up. Its CAPE is 25.0. But here is the key. For Japan, this is only the 40th.5th percentile. It has been cheaper than this nearly 60% of the time. Japan has moved from a deep value trap to what we can now call fair value. The easy re-rating money has been made. The emerging markets, hope, fear, and value. Here we see the full spectrum of emotion. The darlings, India has a CAPE of 36.8 in the 93rd.9th percentile. It is expensive. The incredible optimism about India's future is baked into the price. Similarly, Taiwan is at a CAPE of 32.0, the 99th.6 percentile. It is essentially at its absolute historical peak. The punished, China, is the opposite. Its CAPE is 15.2 in the 53rd.6 percentile. That is fairly valued, but the real story is in the comparison. China's price reflects deep pessimism. For the contrarian, it offers a potential margin of safety. The bargain bin, look at Brazil at 10.3, the 24th.4 percentile, Turkey at 6.7, the 6.1 percentile, and Indonesia at 14.2, the 14th percentile. These markets are historically cheap. They are priced for fear. Conclusion: the disciplined path. So, the map is clear. The United States, India, and Taiwan are markets of hope and high prices. The United Kingdom and much of Europe are markets of caution and relative discount. Japan is fair, and China, Brazil, and Turkey are bets on a turnaround. The old rule holds: be fearful when others are greedy, and greedy when others are fearful. The data shows you exactly where the greed and fear live right now. And remember the final, crucial truth for the long-term investor. The market is a master of testing your patience, not your intelligence. An expensive market can stay expensive for years, rewarding those who simply stay in their seat. And a cheap market can stay cheap for even longer, punishing those who try to be too clever. Your job is not to outsmart the market's every mood, but to outlast them with steady, unshakable discipline.